In trading, everyone talks about psychology and money management. You'll hear the same advice over and over. Control your emotions, cut your losses, let your winners run. And yes, those things matter. But here's a hard truth that most traders never want to face. If your entry is wrong, 90% of the battle is already lost. Think about it like stepping into a boxing ring. You might have the best coach in the world, the best training camp, the strongest defense. But if in the very first exchange you leave your ribs wide open, it doesn't matter how good you are. One clean shot and you're already fighting from behind. That's exactly what happens with trading. A poor entry leaves you exposed. Suddenly your stop loss feels too tight, your confidence starts to slip, and every tick against you feels like a punch in the gut. Before you even get to test your discipline or your money management rules, the market has already taken control of the fight.
Every trader, at some point, comes across what people call the three pillars of success: entry, money management, and psychology. Think of it as a triangle. Remove one side, and the entire structure collapses. Now let's be clear, all three are important. No professional would ever tell you to ignore discipline or risk control. In fact, Paul Tudor Jones famously said, "Don't focus on making money, focus on protecting what you have." And Mark Minervini, one of the U.S. Investing Championship winners, has stressed that timing is everything. Without the right timing, even the best money management only limits the damage. It doesn't create profits. Here's the nuance, though. Order matters. Money management and psychology are like safety nets. They keep you alive once you're already in the trade. But a safety net can't stop you from falling if you're constantly jumping from the wrong platform. In other words, if your entries are poor, the other two pillars are forced into damage control from the very beginning. And that brings us to the real problem.
Most traders don't fail because they lack discipline or because their stop-loss rules are flawed. They fail because they keep putting themselves in bad positions right from the start. It's not the rules that break them, it's the entry that sets them up for failure. So let's make this concrete. What actually happens when you enter at the wrong place? That's where the real lessons begin. If you've traded for any length of time, you know that most losses don't come from violating stop losses or ignoring money management rules. They come from being in the wrong place at the wrong time, from bad entries that never gave you a fighting chance. Take gold, for example. Look back at 2013, one of the worst years for gold in decades. The long-term trend was clearly down. Gold had broken below key support around $1,525 an ounce and went on to lose nearly 30% that year. But what did many retail traders do? Every time they saw a single green candle, they jumped in, hoping to catch the bottom. On the surface, it looked logical. Gold has fallen so much it has to bounce. But the reality was harsh. Those quick entries against the broader trend were swallowed by a tidal wave of selling. Stops got hit, accounts took heavy damage, and confidence evaporated. The failure wasn't in the stop placement. The failure was stepping into a falling market with no edge.
Or consider the stock market during choppy, sideways periods. Think about the S&P 500 in mid-2015, before the August correction. For months, the index moved in a tight, frustrating range. Traders who entered aggressively on each breakout attempt were punished over and over as the market reversed back into the range. Stops were triggered repeatedly, and small losses piled up into something much larger. The lesson here is simple. Entering without confirmation in a sideways market is like trying to sprint through quicksand. The more you struggle, the faster you sink. Both of these examples highlight the same truth. It wasn't the size of the stop loss that caused the pain. It wasn't a lack of discipline. The core issue was the entry itself. When you're positioned on the wrong side of the market, even perfect discipline can't save you. All it does is ensure you bleed slowly instead of all at once.
Losses on their own don't destroy traders. It's what those losses do to the mind. A wrong entry doesn't just drain your account, it drains your confidence. Think about the sequence. You take an entry against the trend, and the market quickly proves you wrong. You cut the loss, but now you're unsettled. On the next setup, you hesitate, doubting your system. Then, when you finally pull the trigger, you're either too early or too late because fear has already crept in. The result? Another loss. And with each misstep, frustration builds until you're no longer trading your plan at all. You're trading your emotions. This is where the real danger begins, revenge trading. One bad entry turns into 2, then 3, as you try to win back what you've lost. The discipline you swore you'd follow, risk limits, patience, position sizing, gets thrown aside in the heat of frustration. You're no longer trading the market. You're wrestling with yourself. A bad entry is like a grain of sand inside a clock mechanism. At first, it looks harmless, barely noticeable. But as the gears turn, that grain grinds against the metal, jamming the system piece by piece. Before long, the entire mechanism seizes. That's what happens when poor entries seep into your psychology. Small errors snowball into a total breakdown of discipline.
And history has shown this pattern again and again. Behavioral finance research from people like Daniel Kahneman and Richard Thaler has proven that losses carry twice the psychological weight of gains. In trading, that imbalance magnifies. A poorly timed trade can linger in your mind long after the position is closed, creating hesitation, doubt, or recklessness in the next one. Here's the irony. Traders often think psychology is what saves them, but in reality, it's the wrong entry that destabilizes psychology in the first place. Protect your entries, and you protect your mindset. Fail at entries, and the strongest psychology will eventually crack. And that brings us back to the central question. If psychology and money management depend so heavily on the quality of your entry, doesn't that mean the entry itself carries most of the weight? That's where the numbers become clear, and why many traders say 90% of results come down to one thing: where you choose to step in.
When traders talk about success, they often highlight money management and psychology, and those are absolutely critical. But here's the catch. Both are conditional advantages. They only work if the entry gives them something to protect. Think about tight stop losses. They're designed to limit risk. But if your entries are consistently poor, chasing at the top of a move or fading a strong trend, a stop loss isn't a shield, it's just a revolving door. You're in, you're out, and your account slowly bleeds. Or consider patience. We praise traders who wait, who don't panic. But patience with a losing position isn't discipline. It's denial. Sitting still in the wrong trade doesn't transform it into a good one. It only prolongs the inevitable.
Professional traders understand this distinction well. Look at systematic trend-following funds, some of the most successful strategies in modern finance. From Richard Dennis's turtle traders in the 1980s to large CTAs, commodity trading advisors, today, the principle is the same. Entries are aligned with the dominant trend. Once they're in the right direction, money management does its job, cutting losses quickly, letting winners run. But the edge always begins with the entry. Without that, risk control is nothing more than controlled failure.
The core idea is simple but powerful. A good entry tilts probability in your favor. It doesn't guarantee a win, nothing in markets ever does, but it shifts the balance. Maybe your system only wins 40% of the time, but if those winners are entered at high probability spots, the payoff is larger than the loss. Over time, that small edge compounds, just like interest in a bank account. One trade doesn't change your life. 1,000 good entries applied with consistency can. Now, if entries are the foundation, the obvious question is, what makes a good entry? Traders have argued about this for decades, but the principles are surprisingly consistent. They're not about secret indicators or magic formulas. They're about aligning with the market's logic. Let's break it down into 3 golden rules. Rule number 1. Trade with the larger trend. Markets move in waves, but the tide always matters more than the ripples. Fighting a dominant trend is like swimming upstream. You burn energy and make no progress. Professional traders don't waste time guessing bottoms or tops. Instead, they buy pullbacks in established uptrends and sell rallies in established downtrends. Look at Apple's long-term chart from 2019 through 2021. The stock had multiple pullbacks of 10 to 15%, but each pullback within the uptrend gave traders far better entries than those who tried to call a top. Following the tide is often the difference between a trade with tailwinds and one that sinks immediately.
Rule number 2. Wait for confirmation. One green candle doesn't make a reversal, and one red candle doesn't start a crash. Smart entries come from patterns, retests, or multiple signals lining up. Maybe it's a support level holding after several attempts, or a breakout that survives a retest before taking off. Confirmation doesn't guarantee success, but it filters out noise. It's the difference between chasing shadows and waiting until the market shows its hand. Rule number 3. Choose low-risk locations. Good traders don't just ask, where can I make money? They also ask, where can I be wrong quickly and cheaply? That's why strong entries are placed near logical levels, support, resistance, trend lines, places where you can set tight stops with big potential upside. A clean risk-to-reward profile gives your edge room to work. Without that, even a correct idea can become a losing trade.
These 3 rules may sound simple, but simplicity is often what separates professionals from amateurs. Most losing trades break one of these rules. They fight the trend, they jump in without confirmation, or they enter in the middle of nowhere with no defined risk. And here's where it all ties together. Following these rules isn't just about technicals, it's about patience, because the market rarely hands you a textbook entry right away. More often, it tests your ability to wait, to sit on your hands until the odds line up. And that patience, that hidden test, is where most traders stumble. If there's one weapon the market uses more effectively than volatility, it's time. Prices whip up and down, yes, but what really wears traders down isn't the size of the swings, it's the waiting. Most traders don't blow up because of one giant move against them. They blow up because they can't sit still. They jump into false breakouts, take boredom trades just to feel active, or chase after a move they already missed. In each case, the market doesn't have to punish them with big losses. A slow bleed of small, unnecessary losses is often enough to drain an account and the trader's confidence. Patience is the test almost nobody talks about, but it's everywhere. Look at any successful trend follower or any disciplined swing trader. Their biggest wins didn't come from trading more. They came from waiting longer. Jesse Livermore, one of the most studied traders in history, put it plainly. It was never my thinking that made the big money. It was always my sitting.
The truth is, the market rewards restraint just as much as it rewards knowledge. A fisherman who thrashes the water won't catch fish. He'll only scare them away. Trading works the same way. Constant action isn't a sign of discipline. It's often a sign of fear or boredom. Real discipline is knowing when not to act. And here's the line to remember. The market is infinite. Your capital is not. Patience is the bridge between the two. The opportunities will never run out, but your money will if you chase every flicker on the screen. Which brings us full circle. If entries determine 90% of your results, and patience is what allows you to wait for the right ones, then the message is clear. Master your patience, master your entries, and your trading will transform.
Trading isn't about predicting every move or winning every trade. It's about stacking the odds in your favor. And 90% of those odds come from one thing: where you choose to enter. If you fight the trend,
If you jump too soon without confirmation, if you place trades in no man's land with no clear risk, you're giving the market the advantage before the battle even begins. But if you wait for the right spot, if you align yourself with the bigger move, if you manage risk from a position of strength, then psychology and money management finally have room to work. The market is infinite. Your capital is not. Patience, discipline, and precise entries are what bridge the gap. Master those, and you've already won most of the fight. If this lesson spoke to you, make sure you subscribe, because the markets won't wait, and neither should you. There's more to learn, and we're just getting started.